there is an emerging consensus driven by colleagues in economics mostly, that focuses on issues such as compensation, too big to fail, and the risks that banks were taking, pushing themselves to the limits. The interesting thing is that once you start looking at the sector a little bit more closely, you see that reality is slightly different. And what is worrisome is that we have substituted actual empirical analysis of many of the pathologies that emerged with assumptions that are based on analytical models. What actually we did do is that we elevated three agencies, Standard & Poor's, Fitch ICBA, and Moody's, into the role of arbiter of quality. Not only did we elevate that, but we essentially pushed banks to focus on the securities that would get good ratings from the rating agencies. And the rating agencies were essentially oligopoly of just three, with no further competition that was allowed because of the structure that the regulators had actually put up. So it works rather differently, because what we're telling banks is, look, if you're going to have a securitized loan rather than lending to a business, then you can have half, or in some cases a fourth, of the capital that you will have on your balance sheet. Guess what the banks did? Rather than lending to businesses directly, they said, great, let me get some more of these securitized loans, because this way I need to hold less capital. This was something that we provided as a context. And what did we say to these people that are doing the risk assessment? We said, maximize your profits. That's what you should be doing. And what you had were people like the CEO of Standard & Poor's that was boasting that he trebled the revenue that he was getting per employee, that is, spending less time and getting more money being paid by the people who issue to create these securities that were gorged up because we, as society, as regulators, gave the incentives to banks to do so. There are many choices that we make that we're not fully aware of. One of the interesting challenges that we face, and I think that this is evident in the financial crisis, is that there has been excessive compartmentalization. We have been looking what problem, one regulation at a time, and the system of regulations that we have, which is why I'm taking an evolutionary perspective, trying to think about the dynamic of the system as it evolves, simply doesn't hang together well. It's not a question of creating something that may need to have some risks. It's a question of structuring it in a way that will inevitably, unavoidably lead it to an outcome that is going to be inefficient and corruptible. And I think that we can improve substantially the potential chances that society has to have a safer system if we start thinking about the dynamic interaction of these conditions that we give to the different institutions. And mostly, if we start taking a behavioral view, if we try to think of banks not as abstractions, but figuring out what exactly did they do? What were the drivers of them taking up more risk? Not at a general level, at a specific level. What were the regulations that they were reacting to, and how can we potentially change them in order to increase the resilience of the system? So I'd say we have a lot of progress to make before we hit this appropriate risk versus growth or return trade-off that we're trying to get at.